Canada has lost 112,000 jobs since January, and on Wednesday, copper on the COMEX hit a record $6.69 per pound. Those two facts are not supposed to coexist in the same economy, and yet here they are, in the same trading session. April's jobs report, released Friday, showed Canada shedding 18,000 positions, the third monthly decline in 4. Unemployment climbed to 6.9%, a 6-month high. Statistics Canada tied the weakness directly to tariff uncertainty and trade disruption. Meanwhile, the Canadian dollar extended its daily losing streak to 6 sessions, trading at 1.3705 against the US dollar, 72.97 cents. The Bank of Canada's meeting minutes, also released Wednesday, showed the Governing Council felt it could afford to stay patient at 2.25%. BMO's Canadian rate strategist described the central bank as comfortable standing pat. Patient is one word for it, disconnected from the labor data is another. The equity session had its own split personality. The TSX tilted lower through most of the day, as tech and consumer stocks reflected the labor weakness. But the materials sector bucked that. Copper futures on the COMEX surged 2.4% to that record $6.69 per pound, widening the premium over London Metal Exchange prices as tariff bets pushed U.S. buyers to front-run potential import duties on refined metal. LME copper itself rose 1.6% to nearly $14,200 per ton, within $300 of its own all-time high of $14,500 set in January. Agnico Eagle, Canada's largest mining company and the world's second biggest gold producer, announced a $14 billion commitment to Ontario operations through 2030, a 20 to 30% production expansion targeting 4 million ounces by early next decade. At nearly the same moment, news broke that Honda had indefinitely suspended its planned $15 billion electric vehicle and battery complex in Alliston, Ontario. Ontario and Ottawa had pledged up to $2.5 billion each to support it. Not a dollar had been dispersed. The two $14 to $15 billion numbers arrived on the same day, pointing in opposite directions, one commodity company doubling down, one industrial manufacturer walking out. What the copper record and the gold investment share is this: neither depends on a healthy domestic consumer. What the Honda exit and the jobs data share is the opposite. Both are direct readings on whether Canada can sustain an economy beyond resource extraction. The session, in other words, was not mixed, it was sorted.
The commodity strength has a specific driver that makes Canada's labor picture look even more exposed. Copper's rally is not a broad risk-on move. It is concentrated in U.S. COMEX pricing, widening the premium over London, precisely because U.S. importers are pricing in tariffs on refined metal. Iran's impact on the Strait of Hormuz has choked off a meaningful share of Gulf oil transit, pushing energy costs higher for industrial producers worldwide and tightening the effective supply de aceballos that go into electrification infrastructure. Supply disruptions that already drove copper 40% higher through 2025 have been compounded by fresh logistics constraints. The result is that copper producers with North American assets, Teck Resources, First Quantum's Americas operations, and Agnico's Ontario Gold Network are benefiting from a tariff geography that favors production inside the continent. Agnico's $14 billion commitment is rational inside that logic. The company is expanding Canadian Malartic and its Ontario mine network because the regulatory environment under Premier Lecce's accelerated permitting push, combined with proximity to U.S. buyers who want non-Chinese supply chains, makes the capital allocation case. What it does not do is employ assembly line workers, software technicians, or the service sector workforce that constitutes the majority of Canada's labor market. Mining at Agnico scale is capital-intensive in a way that concentrates employment in specific technical roles in specific geographies, not across the broad labor market. Honda's exit makes the gap structural. The Alliston complex was designed to employ thousands of workers building electric vehicles for a North American market that, under current U.S. trade policy, would face tariff exposure the moment those vehicles crossed the border. The Globe and Mail's editorial board called the cancellation proof of the subsidy fallacy. No amount of Canadian public money can manufacture auto jobs in a tariff architecture that does not guarantee market access. The $5 billion in combined federal-provincial commitments evaporated without having transferred a dollar. The reversal here is that the resources boom Canada is riding does not replace what the manufacturing sector is losing. The commodity cycle and the job cycle are not moving together. They are moving in opposite directions for reasons that share the same cause: U.S. tariff policy. Here is where that logic develops a pressure point. If the copper record is driven partly by U.S. tariff bets on refined metal imports, the same tariff regime that lifts Canadian miners could also be used against Canadian copper and gold exports if Washington decides continental preferences shift. Canada is currently the beneficiary of a tariff geography it does not control.
The 112,000 job losses since January sit against a backdrop that the Bank of Canada described carefully in its Wednesday minutes. It sees risks on both sides and is not yet prepared to move. The central bank's patience has a hidden assumption that the commodity-driven side of the economy generates enough revenue and enough confidence to prevent the labor weakness from becoming a demand collapse. At 6.9% unemployment and rising, that assumption is being tested by its own data. The 2015 oil price collapse offers an instructive parallel. At that point, commodity revenue and labor outcomes also diverged briefly. Oil-weighted equities held, while Alberta's unemployment surged. The divergence lasted approximately 2 quarters before credit conditions and consumer spending forced the equity side to reprice downward. The BOC cut rates 4 times between January and July 2015. The current setup differs in one important respect. The commodity strength today is broader than oil, and it has a supply-side driver, the Iran war and tariff front-running, rather than solely a demand-side one. Supply-driven commodity rallies do not automatically transmit to employment. They can persist alongside weak labor conditions for longer than demand-driven ones. The continuation case for the current divergence requires the tariff-driven COMEX copper premium to hold, which depends on Washington formalizing tariffs on refined metal imports rather than merely threatening them. If the premium normalizes because the tariff threat passes or because U.S. buyers find domestic supply, the commodity tailwind compresses and the labor weakness becomes the dominant read on Canadian economic conditions. The Bank of Canada would then face pressure to cut, which the loonie 6-day losing streak to 1.3705 suggests the market is already beginning to price. The breakdown case arrives FAVSFARA. Friday's preliminary jobs revision, or May's report, shows the April figure was understated. Canada has shed jobs in 3 of 4 months. One more deteriorating print would make the trend undeniable, even to a patient governing council. Agnico's $14 billion and the copper record would still be real, but they would exist inside an economy whose domestic demand story has quietly become a liability. The verification point. Watch the COMEX LME copper spread. If the premium narrows back below $200 per ton in the next 5 sessions, the tariff front-running thesis loses its structural support. At that point, the labor data and the CAD at 1.3705 tell the cleaner version of Canada's actual position. If the spread widens further, the commodity thesis holds, but the question then becomes whether a mining boom at 6.9% unemployment is a foundation or a ceiling. Every day after the close, we publish a market wrap and key issue analysis. Subscribe to the channel.